Welcome to Making Money. This is Matt McCall. Thanks for joining me. As you can see, back in a Florida studio after nearly 3 months in Nicaragua. Happy to be back. We got a big show for you. We got the Dow trying to make it 12 consecutive up days. And we're going to talk about the U.S. dollar. The U.S. dollar has been a headline lately, continues to drift lower. What this means for your portfolio, what it means for gold, stocks, oil, and then 4 ETFs you can use to hedge your portfolio if you believe the dollar is going to continue to fall. All this and more coming up right now on Making Money. Over 1 million people around the world follow Wall Street veteran Mark Chaikin for his shockingly accurate stock market predictions. He just gave them a dire warning. Mark says, we're about to witness an historic stock market shakeup that can soon create devastating losses for investors who don't know what's coming. And as a result, you only have 90 days to move your money. You see, Mark spent 50 years on Wall Street at some of the most prestigious hedge funds in history. And he's been on Fox Business and CNBC countless times. But this is a financial story no one else is telling. And if you let this take you by surprise, you could be in for a world of pain. He explains everything in a brand new free report available at rollingcrash2023.com. He includes a name and ticker of a popular stock that could be directly impacted by what's happening as well. Mark warned of the beloved pet brand Chewy before it fell 45%. Tech company C Limited before it fell 66%. Furniture company Wayfair before it fell 76%. Social media favorite Snap before it fell 36%. And food delivery company DoorDash before it fell 65%. Mark even called the Amazon crash before the FANG stock fell 35%. So you'll want to avoid the stock in this new report immediately. Again, simply go to rollingcrash2023.com for your free copy of this new report. Again, welcome to Making Money. This is Matt McCall. Thanks for joining me. It's the 25th of July, 2023. It is a Tuesday morning here in South Florida. I got to tell you, I thought it was kind of hot in Nicaragua. I think it's hot, high 80s this time of year. Not a lot of humidity, beautiful breeze. But boy, oh boy, getting back to South Florida. Yesterday was my first full day here, and I sweat like you wouldn't believe. I don't know if my body's changed, but this humidity is absolutely unbearable. The real feels 10 degrees more than it is in Nicaragua. It's completely amazing. So everybody out there who's in the southern part of the United States, it's unbearable. Please be safe. I know there's been a lot of tragic accidents because of the heat, so please be safe out there. Turn on your air conditioning, drink a lot of water, and try to be healthy. So as I mentioned, we have the Dow Jones Industrial Average up 11 consecutive days coming into Tuesday. We always tape this show in the morning. It's about an hour into trading, about 10:30 East Coast time right now. And we have the Dow up a point, so essentially flat. So it's going to be a little tough here for the Dow to get up 12 consecutive days. And keep in mind, this is a pretty rare feat. It's just the sixth time since World War II. Sixth time since World War II that the Dow's been up 11 consecutive days or more. And that's less than once per decade. So this is a really rare feat, if you will. And I take a look at where the Dow's sitting right now, and I don't want to be the guy who flip-flops every week, bullish, bearish, like most talking heads on television, because as you know, I'm bullish majority of the time. And the reason I am is because the market goes up about 75% of the time. And I think right now, the market's had a hell of a run this year. There's no debating that. And I think we end up higher by the end of the year. But again, we could have a pullback after 11 consecutive days. Maybe we make it 12 today, who knows? You're going to have a pullback. So if you're looking to buy some stocks here, maybe you wait a week or two, buy on some weakness. There's nothing wrong with that. Or if you're buying for the next 10 years, trying to time it, you're probably just okay to buy here. If it pulls back 5%, it's not the end of the world if you're planning on holding for 10 years. Let me show you here a chart. And this is a chart of the S&P, all tracked by ETFs, the NASDAQ 100 tracked by the Qs, and then the IWM, which is the Russell 2000 Small and Mid Cap Index. As you can see here in the chart, folks, all different colors, but this shows percentage off a high. And the S&P coming into today, about 4.9% off an all-time high. The orange there, that's the Qs. That's NASDAQ 100, then about 7% heading into today. And then we have the Russell 2000 small mid-cap's been lagging. I've talked about that a while, down about 20%. Still very near that bear market territory. down 20% from the all-time high, all set back in late 2021, very early 2022. But what's more important I want to look at here is that blue line, and that's the Russell 2000. Let's go back to the first time it came down in 2016. It fell by over 20% in that time, over 25% as a matter of fact. It happened again at the end of 2018. And if you remember, that was nearly a bear market for the S&P. It was down about 18, 19% heading into the end of December. Then we had a big rally. As you can see, the markets rallied back big from there. And then we had another one with COVID. Obviously, everything got hit at that time. And then again, as of late, from the 2021 highs. So just going back to 2016, so in the last 7 years, we had 4 instances, folks, where the Russell 2000 has pulled back at least 25%. What did it do every time after that? It came back to new all-time highs. And I don't see that changing this time as well. Could it take time? Yes. But when you're 20% off a high, you need to go up. Obviously, if you fall from 100 to 80, to go to 80 to 100, again, you're going up that 20%. So I believe that it's very, very doable. And I think, again, that will happen probably the next 12 to 18 months for the Russell. I wouldn't be surprised, though, if it happens before the end of the year, especially if the Fed goes one more time. We'll talk about the Fed in a second, pauses, and then eventually cuts next year, because that would be very, very bullish for the smaller mid-cap companies. So that's kind of where we're seeing the markets right now. Again, bullish long-term, bullish intermediate term, very short-term. You can't stop the market when it's this type of momentum, but just be realistic that you don't go up every single day. So as I mentioned with the Fed, they come out Wednesday afternoon. I'm going to have a Fed special bringing on to my good friend Paul Schatz, who's been managing money for a very long time. I've known him for over a decade, a great macro analyst. He's going to come on. We're going to have a very special Fed show that goes out Thursday. So we're going to have him come on after the Fed announcement Wednesday afternoon. After Jerome Powell, the Fed chairman, speaks, we'll get all the insight into that from both myself and from Paul Schatz coming up on Thursday's show. So you don't want to miss that. The expectation is about 99.5% chance that the Fed will raise interest rates by 25 basis points to a range of 5.25 to 5.5%. This would be the highest level since September of 2007. So we're looking at about a nearly 16-year high for the Fed funds rate. All that being said, we still have growth in the economy. The Atlanta Fed, which puts out its estimates for GDP for the second quarter, which we'll be getting soon. Second quarter GDP growth, the estimate's 2.4%. Most economists, which I could care less what economists think, as you know, believe it's going to be about 1.5 to 2.2. There's a range in there, so let's call it high ones, low twos. And as I mentioned, the Atlanta Fed believes it's 2.4. I'm not an economist, so I don't put out predictions of where the GDP is going to be. I do believe it's obviously going to be positive, and I think that's going to be one more quarter for the people calling for this big recession to come, for them to be incorrect. So speaking of incorrect, folks, I am what they call a ball buster. For my best friends, for my family, I'm always busting people's chops, or maybe say busting chops. And but in a loving way, not to hurt anybody, but in a loving way. I like to call people out. And I realize when you do that, you must get called out. And I'm okay with that as well. I'll fight back if I think you're wrong, but I'll let you call me out. So speaking of economists and being wrong, obviously, economists are historically wrong. Just Google accuracy of economists, and you'll get a lot of articles just showing. You can read for yourself. But calling people out, busting chops, I happened to turn on CNBC. I didn't even turn it on. I was looking at something online, and it popped up. And Joe Kernan, who I have mad respect for, who at Squawk Box in the morning has been there for decades, I think, probably at least 15, 20 years. I like him because he calls people out. And there was a woman that was on today. I don't want to say her name. She was on today, and I don't have a view of her bullish or bearish, positive or negative. I don't know much about her. But that being said, Joe Kernan went at her, and she's a regular guest on CNBC. And, saying because she was now suddenly bullish and had been bearish for a very long time. So Joe asked her, when did you become bullish? She said mid-May. And he kind of laughed because mid-May is basically 2 months ago. She's claiming, all this stuff. She knows everything. And anyway, just seeing this, we kind of have to hold people accountable, and we don't do that enough. And that brings me to Mike Wilson. Mike Wilson is very well known in the Wall Street circle for being bearish last year, and boy, was he correct. That being said, in December, he said the S&P was going to fall to be between 3,000 and 3,200. Let's take a look at the S&P, folks. As you can see here in December, it was down around 3850 or so, call it 38. So he thought it was going to go back down to 3,000, 3,200. Which, if we zoom out here, you can kind of see how amazing this call was. You're calling for it to go back really to the dips that we had that was caused by COVID. So basically below where we were before COVID started, taking us back years. And of course, we have it now at 45.63. So Mike Wilson came out in the last 24 hours, put a letter out, and basically came out and said, this is one of his quotes. Actually, this is a quote from May. I'm sorry. We characterize this as the bear market's continuing. The fundamental case does not support where stocks are trading today. That was in May, so he kept going negative. But he came out, sent a letter to his clients as of late and said, we are wrong. So I give him credit for that. I don't want to always bust chops. I give him credit for that. His target now for the S&P is 3,900. So that's, again, let's look at this chart. 3,900, folks. You can see it on the chart. That's a huge pullback, taking us back to where we were in March. So that's a big downside. And it's 4,200 for the end of next year, which, again, is a pullback from here. And could we hit 4,200 before next year? Of course. I don't know where we end next year. But I will say this, that it's still extremely negative outlook because it's still lower almost a year and a half from now. But again, I gave him kudos for coming out and basically saying, hey, I was wrong. On the other side, Tom Lee's been right. He's been very bullish. He's from Fundstrat. And he made a point recently saying that there's still $5 trillion on the sidelines. Normal times, let's say it's $3 trillion. That's $2 trillion that can go in the market. That could really move stocks. So keep that in mind. He also believes that there's strong probability of new highs by the end of the year. His target's 48.25. So still up about, 6-7%, give or take from here. But again, he could be wrong at some point too, and it's okay. I give these guys credit for putting their neck out there like I do, and I've been doing for 20 plus years in the media. And again, just so you know, I'm not just calling people out. I've told you guys many, many times, 2022 was probably the worst year I've had ever. I've been doing this for a long time. Started managing money in 2004, started doing newsletters back in 2002. So over 20 years, probably my worst year. But I'm okay with that because I know you have bad years. Even the Hall of Fame baseball player or football player has bad years. It's just part of life. You have it. So I'll go out there and say it. And that being said, year to date, both our newsletters are doing really well. All of our positions that we started that were in there at the beginning of the year, if you take the averages, put it out, beat your indexes handily. Again, it's only 6-7 month time frame, so I never want to be judging that. I'm be judging long term. But I will say, I will come out and say I'm wrong and let you know why I was wrong. But we have to hold the people out there that we listen to. When I say we, I just said general public, to make decisions. Because you're still listening to a guy like Mike Wilson, you've missed out on a huge rally. And if you believe that his numbers are going to be there for the next 18 months, it means you're sitting out in the market for likely 3.5, 4 years if you listen to that. There's not many 3 to 4 year periods, folks, where the market's down. And I don't think this is one of them. So keep that in mind. All right, I told you we're going to talk about the U.S. dollar. The U.S. dollar, we've had a lot of guests on as of late that have been negative on the U.S. dollar. And that's I don't want to say it's consensus, but it's not consensus. It's definitely a view that quite a few people, at least that I follow, believe that the U.S. dollar will continue to move lower. And I'm going to pull up here a chart of the U.S. dollar index. And as you'll see here in a moment, what it's done as of late. This is an ETF that tracks the U.S. dollar index. The reason I put this up so people know that if you want to buy into the U.S. dollar index or track the U.S. dollar index, this is a way to do it. You can see on the right-hand side, it's rallied the last week, but really a choppy chart. More importantly, let's zoom out a little bit because let's get a better perspective. I'm going to zoom way out on the U.S. dollar. And it had a huge rally. Obviously, this was post-COVID when we started having interest rates go up. And the reason for that is, folks, that interest rates go up, making investments here in the U.S. That are fixed to interest rates much more attractive. So you have money flowing into typically countries where the central bank's raising interest rates, where we saw with the Fed. Now we have obviously the Fed raising rates again this week, almost guaranteed. But the odds are that will be the last one as of now. Things may change after Wednesday's press conference. As of now, that will change. And most likely early 2024, mid 2024 rate cuts. Again, that's so far out, tough to really think about what they'll do then. A lot can change. All that being said, wouldn't surprise me, especially going into an election year, to cut rates and try to create a market rally into November. So, you can believe what you want. The Fed's not supposed to be political, but I think that's BS if you think that there's not some types of ties to that at that point. So the U.S. dollar, I think that it's got a lot going against it. I don't think it crashes, but I do believe that the U.S. dollar versus some foreign currencies could remain negative here for the next, let's say, 12 to 18 months, if not longer. And so I did a little study here this morning looking at the U.S. dollar versus stocks, because a lot of people say, well, if the U.S. dollar goes down, it's good for stocks. It's irrelevant for stocks. I'm going to show you that in a moment. So I took the U.S. dollar and I put the correlation of that versus the S&P 500 versus gold and versus the price of oil. I'm going to show you those here in a second, and we'll get an idea really of what type of correlation there is. But I will tell you this, the average correlation of the S&P 500 to the U.S. dollar over the last 15 years is a negative 0.26. And that has a standard deviation of 0.23. So basically it takes you to flat, no correlation at all, or negative 0.5. So it's not big. And keep in mind that if you have a 1-to-1 correlation, that means you're going to move lockstep. If the S&P is up 1%, dollars will be up 1%. S&P is down 1%, down 1%. If it's a negative 1, it means that the S&P is up 1%, dollars down 1%, and vice versa. So you can kind of do the math there and figure out in the middle what that looks like. So let's take a look at a couple of charts here. And the first one we're going to take a look at is just a correlation of the SPYs, SPY, the S&P 500 versus the US dollar index, the UUP. And all I see there is a mess of, looks like a little kindergarten kid going up and down, up and down, up and down. So it ranges from between about a negative 0.9 to a positive 0.7. Right now it's at 0.04, so it's at about 0 right now. But there's really no correlation there, folks. There's not much at all. Now let's take a look at the correlation between gold and the US dollar. Much more below 0, but again, there's a couple spikes up to about 0.7, going back to 2010, 2019, even 2020, just last year. We're at about negative 0.48, so let's call it negative 0.5. So there's definitely, I believe there's definitely an inverse relationship between the dollar and gold, which means the dollar goes down, gold should go up over time. But again, it's very, very choppy, tough to look at. Now here's oil. This one's a little bit different. You can see as of late, it's really turned positive. It was negative for a long time, 2014, 15, 16, a little spike above in 17, but for the most part, it's been very negative correlation. We've seen this spike as of late, just because of, again, we had oil come back from a low, and then we had the US dollar at the same time rallying last year, so it kind of went hand in hand. But that's starting to roll over, and I think it will. So what that's going to lead to, in my opinion, is oil doing the inverse eventually of oil. Oil doing the inverse of the US dollar, I'm sorry. So I'll get to that in a moment, coming back to oil. But let's talk about real quick gold, because I know everybody thinks I despise gold. I don't despise it. I think more of what irritates me, and more of what I'm against is gold bugs. Only because it's like debating a political, somebody who's very into politics, left or right, far left or far right, that just won't budge on anything. It's just, you can't debate a person like that. When it comes to gold, you can't debate gold bugs because they're just bullish gold 24/7. They sleep with it under a pillow. They probably cuddle it and give it a kiss in the morning. It's kind of an issue, something you should probably talk to your therapist about, honestly, the way that gold bugs are. So yeah, they annoy the hell out of me because you can't debate them, and people who can't debate are uneducated, in my opinion. So I know it's going to hurt a lot of people's feelings, but you have to be open to debate. I'm wrong all the time, and if you could change me otherwise, I will. And I haven't liked gold for a long time, but I told you a few months ago we had a guest on and we talked about gold. I said you're starting to sway my opinion, and as you can see here, I'm pulling the chart of GLD. It did try to break out in May. It's been drifting lower, kind of going sideways. We're at the same level now that we were back in January. So it really hasn't moved much. Still up for the year because we had a rally to start the year in gold. But, when I look at the long-term chart of gold now, the reason I can't get bullish on it here is I go back to 2020 where GLD was up in the low 190s, hit it again in early 2022, hit it again in early 2023. So unless you break above that level or pull way back and create a buying opportunity, I don't see the upside. If the US dollar crashes and something crazy happens, some black swan event in the world, yeah, we could see it go higher. I'm not rooting for that either. I'm not rooting for anything because I don't have any exposure to gold. All this being said, folks, that's why I'm not liking gold here. The upside is so limited. Unless you break out, if you break out, I'd reconsider it. I will say it. I will tell you, I will reconsider it, and I'll come out here and say I was wrong. But until then, I'm not going to say it because I haven't been wrong with it. Gold really has not been doing what it's supposed to be doing, especially during high inflationary times. The other effect of the U.S. dollar is on earnings. And obviously, we're in earnings season. About 30% of the S&P, 40% of the Dow report this week. A lot of big tech earnings in the next couple of days. So that's going to be important for the market. About 40% of the S&P 500 revenues are generated outside the U.S. Nearly 60% of revenues from companies in the subsector IT, information technology, so tech companies. About 60% of company sales come from abroad of companies in the IT subsector within the S&P 500. So a strong dollar can hurt stocks a lot of times because if you're a multinational and you're selling overseas, the goods or services you're selling to people overseas when the dollar's high is more expensive to them. So they're buying less potentially. And you have the conversion back. So it does hurt a lot of times, the S&P 500, and especially the large multinationals, you see them hurt. So the U.S. dollar coming down has been a bit of a boon to some of these large stocks, especially the IT names. So if the U.S. dollar continues to drop, one way to potentially play it is play the big tech names. The big seven, magnificent seven, whatever they're calling, they got to pull back, folks. They can't go up forever. But again, that could be one way to hedge a little bit. So here are the four investments that I think could be U.S. dollar hedges for you. The first one we're going to take a look at is pretty simple, and this is the opposite of UUP. This is UDN. This is the Invesco U.S. bearish fund. So it does the inverse of what the U.S. dollar does. So as you can see here, it's had a nice year running up, and as the last week we've had the U.S. dollar increase, this has pulled back. But you can see the range of the last 12 months or so is between 1680 and 1940. So that's a $2.60 range. So it's not a big range. It's less than 15%. So you're not going to get a huge move. But if you think that that stocks will fall because of this, because of the weak U.S. dollar, and you want to keep your stocks, but you think you're almost guaranteed the dollar is going to go down, and you believe that's going to go down, nice way to hedge. So that's just one idea there for you. We can also look at other currencies. And one to look at is the euro, because you're going to see here the chart of the euro almost exactly the same as the inverse U.S. dollar index I just showed you. So here's FXE. This is the euro. Also a good way to hedge if you got some big European plans coming up and you want to hedge if the euro is going to go higher, hedge your big purchases out there when you're gallivanting through Paris and you want to buy something nice. Me personally, I prefer Milan if I'm going to do my shopping, or even Florence. I have a couple of nice shops I like there. But it's one way to hedge as well. Again, we'll hedge against the U.S. dollar going lower. And then, as I mentioned, oil. So two out there. This is the XLE. This is the big ETF in the energy sector. As you can see here, it's hit a new 2-month high as of late. It's looking strong. Oil prices are coming back. Oil stocks are coming back. And if I take a look at a long-term chart, you see it's not far from multi-year high. I think oil could be a silent winner here in the next few months to the next year, in my opinion. I think oil prices remain elevated. And then the other oil ETF is the VanEck Vectors Oil Service ETF, symbol OIH. This is more of the services play versus the producers make up a bigger part of XLE. You can see that, if we close here for OIH, we're going to zoom out and show you, this would be the best close since mid-2019. Obviously, well off the highs of this in 2008, above $1,500 a share. It's at $337 now. But again, coming close to a 4-year high on OIH. Nice way to play because a lot of money still being spent on the oil fields and the services that need to be provided for those oil fields. So that's kind of where we stand right now. I wouldn't be too aggressive in trying to hedge anything because I think stocks continue to move higher over the longer term. That being said, I wanted to put those out there for you because, again, the goal of the show is to educate first. So educate you on the US dollar, what it truly means for correlations. Educate you on ways to hedge in case you believe or are concerned about the US dollar continuing to fall. Have some fun. Hopefully you had some fun watching the show. And at the end of the day, make some money because that is the name of the game. Or as they say here, the name of the show. And just to give you an update on the Dow Watch is on. Will it be 12 consecutive days? Right now we're up 17.5 points. And we have what? 6 hours left. The countdown is on, folks. Don't forget, coming up on Thursday, big show, Paul Schatz coming. We're going to be talking about the Fed. Did they make the right decision on Wednesday? More importantly, what's their view of the next meeting coming up? We'll break that down, what it means for your portfolio coming up on Thursday. Don't forget to share, like, comment on the video. Thanks so much for watching. Have a wonderful Tuesday, Wednesday. We'll see you back here Thursday. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.